Okay, something here does not add up, and I need you to see this. Bezos, one of the richest guys on the planet, borrowed over $1 billion against his Amazon stock. Not sold any shares, he literally walked into a bank and took out a loan. Why would someone worth $100 billion need to borrow anything at all? That question is what this whole video is about, because the answer is not what you think. 3 words explain everything. Buy, borrow, die. One strategy that saves billionaires billions in taxes every year. Here's the wild part. The top 25 billionaires paid an effective tax rate of 3.4%. The average American pays around 25%. The system is not broken, it is working exactly as it was designed. The formula is simple. Debt is not income, and only income gets taxed. So you borrow to fund your lifestyle, the IRS sees nothing, your assets keep growing, and the secret is not what rich people earn, it is what they never sell. Let us follow the money. Before we get into the mechanics, I want you to feel how genuinely weird this is. You have $100 billion sitting in stock. You want a private jet, a mansion, a super yacht. Why would you borrow instead of just selling a few shares? The answer is one word: taxes. The moment you sell any asset, the IRS calls it a taxable event. You bought shares at $10, now they are worth $1,000 each. That is a $990 gain per share, and the government takes up to 23% immediately. On a $100 million sale, that is a $25 million tax bill gone instantly. But if you do not sell and instead borrow against those shares, something totally different happens. The loan is not income. Under US tax law, borrowed money is never taxable because you have to pay it back. So you get tens of millions in cash, spend it however you want, and pay exactly zero to the IRS. Meanwhile, your stock keeps growing untouched. Rich people do not get richer by earning more. They get richer by never turning their wealth into taxable income in the first place. The loan gets rolled or refinanced, the stock is never sold, and the gains are never taxed. Paying 3% interest on a $50 million loan is way cheaper than a 20% capital gains bill on that same $50 million. The wealthy do not earn their lifestyle. They borrow it because borrowed money is never income, and income is the only thing the IRS can actually tax. The strategy has 3 stages, and once you see them, you cannot unsee them. Stage 1 is buy. Wealthy people accumulate assets like stocks, real estate businesses, and they do not take big salaries. Steve Jobs, Larry Ellison, Elon Musk all took $1 a year in salary. Their net worth was hundreds of billions, but their salary income tax was basically nothing. Their wealth grew through ownership, and ownership is not income, so the IRS cannot touch it until you sell. Stage 2 is borrow. Once those assets have grown, they use them as collateral for low-interest loans called securities-backed loans. Banks love these deals because the collateral is rock solid. The cash funds, the jets, the mansions, the donations, and none of it triggers a single dollar of taxable income. The loan interest is often tax deductible on top of that, which reduces their tax bill even further. Stage 3 is die, and this is where it gets genuinely wild. When a wealthy person dies, their heirs inherit everything at the current market value, not the original purchase price. This is called the stepped-up basis. Every decade of unrealized gains, all that appreciation never taxed because it was never sold, gets permanently wiped clean at death. Outstanding loans get paid from the estate, and heirs get the rest with a completely fresh tax basis. This rule has been in US tax law since 1921, and every serious attempt to eliminate it has failed. Buy, borrow, die is not a loophole. It is the intended design of the American tax code used exactly as written generation after generation. Now, let us talk about the actual engine that makes this whole machine run: leverage. Ultra-wealthy people do not just borrow to fund their lifestyle, they borrow to build even more wealth. And this is where it stops being a clever tax trick and becomes a genuine wealth acceleration machine. The core idea is simple. If you borrow money at 3% and invest it returning 8, 10, or 15%, you are printing money. That gap between what borrowing costs you and what your investment returns is called arbitrage. And for wealthy wealthy people, it is almost always positive. Real estate example. You buy a commercial building worth $10 million, you put in $2 million of your own cash, and borrow $8 million from the bank. The property spits out $700,000 a year in rental income. After paying the loan interest, you net around $400,000. On a $2 million investment, that is a 20% cash return. And if that building goes from $10 million to $15 million in value, you just made $5 million in appreciation on a $2 million bet. That is 250% return on your actual cash, not on the total property value. Depreciation deductions shelter the rental income from taxes every year. Interest is deductible. A 1031 exchange lets you roll proceeds into the next property with zero capital gains triggered. This is exactly why real estate has created more American millionaires than almost any other single asset class in history. The same leverage principle applies to stock margin accounts, private equity business acquisitions, even art collection. You buy a painting with a loan secured against your portfolio. The art appreciates you. Sell you, repay the loan, and pocket the gain. Even hobbies become financial instruments. Regular people save money first, then invest it. The wealthy invest first using borrowed money, then let the returns compound for decades using other people's capital. The better your collateral, the cheaper your borrowing cost. The cheaper your borrowing cost, the larger your arbitrage. Wealth attracts cheap debt. Cheap debt builds more wealth, and that cycle accelerates every year. Let us open the actual playbook. 4 specific tools that ultra-wealthy people use to pull cash out of their assets without selling and without creating a single dollar of taxable income. Tool 1 is the cash out refinance. You own a property worth $5 million free and clear. You go to the bank, refinance it, and borrow $3 million against it. $3 million lands directly in your bank account as a loan, not as income. You pay zero taxes on it. The property rental income keeps covering the new mortgage payment every month, and you walk out with $3 million in tax-free cash ready to deploy wherever you want while you still own it. Tool 2 is the securities-backed line of credit. Goldman Sachs, Morgan Stanley. These banks offer what is called a pledged asset line. You pledge your stock portfolio as collateral, and the bank gives you a credit line at 1 to 3% interest. You draw from it when you need cash. You pay interest only, and your stocks keep growing untouched, as if you never borrowed a thing. Tool 3 is the home equity line of credit. Own a $3 million home free, and clear borrow $1 million against the equity and invest it. The interest may even be tax deductible if you use it for investment purposes. Tool 4 is overfunded whole life insurance, which financial planners call infinite banking. You dump large premiums into a permanent life insurance policy. The cash value grows completely tax-free inside the policy, and you borrow against it at low internal rates, with no credit check and zero tax implications. The loan and interest just get deducted from the death benefit, and heirs receive the rest completely tax-free as life insurance proceeds. 3 tax advantages stacked in one product: tax-free growth, tax-free borrowing, tax-free inheritance. Every tool follows the same structure. Use existing wealth as collateral, extract cash without creating income, deploy that cash to build more wealth, and never trigger a taxable event. You need wealth to access the tools that build more wealth, and the tax code is not accidental, it is actively maintained. Up until now, we have been watching this machine run smoothly. But every machine has a failure mode, and this one is catastrophic when it hits. The whole strategy depends on one assumption. Your underlying assets keep going up. You borrowed $50 million against a portfolio worth $100 million fine as long as it stays above a certain level. But what happens when the market crashes 40% like it did in 2008? Your $100 million portfolio is now worth $60 million. The loan has not moved. The bank sends a margin call. Add cash right now, or we start selling your assets. If you cannot move fast enough, the bank begins force selling your positions at the worst possible moment, locking in permanent losses that a simple hold strategy would have eventually recovered. In 2022, when rates spiked and tech stocks crashed, several billionaires saw their net worth fall 30 to 60% within 12 months. Some faced genuine liquidity crises, massive assets on paper, not enough cash to meet their obligations. Then there is interest rate risk. When borrowing costs were near zero, this strategy was almost effortless. But rates climbing from near zero to 5% really compressed the arbitrage. Regulatory risk is also real. ProPublica investigations and Senate hearings have put this on the public record, and the political environment is shifting. The wealthy hedge against all of this with put options, Treasury bonds and cash reserves. They insure the machine against its own failure mode. The risk is real, and most people using leverage at a smaller scale have none of those hedges. Alright, the case file is complete and the verdict is clear. This is not a story about criminals. This is a story about a tax system built over decades of legislation to treat asset-based wealth dramatically differently from income-based wealth. The working person earns a salary, and every single dollar is immediately visible to the IRS withheld at the source and taxed at ordinary rates up to 37%. The wealthy person owns assets. Those assets grow invisibly untaxed until a voluntary sale finally happens, and through buy, borrow, die, that sale can be postponed indefinitely across generations through a perpetual cycle of borrowing and refinancing. Interest paid on those loans is often deductible as a legitimate investment expense. The assets themselves are sheltered by depreciation deductions, 1031 exchanges, and qualified opportunity zones. And at death, the stepped-up basis permanently erases every single dollar of lifetime appreciation, handing the next generation a completely fresh tax slate with zero capital gains liability. This system has been largely unchanged for over a century. Every serious attempt to reform it has hit extraordinary political resistance from the exact people who benefit from it most. What has changed is public awareness. More people now understand unrealized gains, stepped-up basis securities-backed loans, and leverage than at any point in American history. Awareness is always the first requirement of meaningful political change. Some of these tools are accessible to regular people too. Real estate investing is accessible with a 20% down payment. Index funds in a taxable account grow unrealized and untaxed for decades. Tax loss harvesting delays your liability every year. Understanding the difference between long-term capital gains rates and ordinary income rates fundamentally changes how you should structure your investments. The tax code rewards financial literacy ruthlessly without exception. The question is never whether rich people are breaking the law. The question is who writes the law and who benefits from it. Debt is the only financial instrument that converts wealth directly into lifestyle without ever triggering a tax event. That was never a secret, it was just never explained quite like this before. Stay curious, follow the money. Case closed.